Okay, welcome back to the deep dive. So today we're jumping into dividend stocks.
Right.
Now, if you follow the markets, dividend payers, they've often done better historically, haven't they?
Yeah, they tend to outperform the non-dividend ones
Mhm.
and often with a bit less volatility, which is, well, pretty interesting right now.
Exactly, given how the S&P 500 has been a bit up and down. And there's this talk about potential tariffs, right? Could shake things up for businesses.
Absolutely. So that idea of, steady income, maybe a bit more stability, dividend stocks start looking quite attractive.
Makes sense. So our mission today, we're looking at some research from the Motley Fool. They've picked out 3 specific dividend stocks. Ones they think could be good long-term holds, even if you're just starting out with, say, $500.
Right, a manageable starting point.
So we're going to dig into these 3, see what makes them tick. First up is Realty Income.
Okay, Realty Income, ticker is O. It's a REIT, a real estate investment trust. And their thing is retail properties.
Retail.
And what grabs investors often is the monthly dividend. That's pretty unusual.
Monthly. Wow. Okay.
And the yield right now is around 5.6%. And being a REIT, they have rules about distributing income as dividends. That's why yields can be appealing.
Right. That structure forces the payout. So monthly dividends, that's quicker cash flow than quarterly.
Exactly.
And they're not small, right? The Fool mentioned a big portfolio.
Oh, yeah, huge. Over 15,600 properties. And the tenants are names you'd absolutely recognize, like 7-Eleven, Dollar General, Walgreens.
Okay, the essentials, pretty much.
Right. And the key to how they manage that consistent income for the dividends is their lease model. It's called triple net.
Triple net lease. Okay, what does that actually mean?
It basically means the tenant is responsible for the big variable costs, property taxes, maintenance, and insurance.
Ah, so Realty Income doesn't have to worry so much about those costs suddenly jumping up.
Precisely. It makes their income stream much more predictable. Think about inflation recently. This model helps insulate them from rising property running costs.
Okay, so that's the benefit for Realty Income. What about the tenant? Why would they sign up for that?
Well, often the trade-off is a lower base rent compared to other lease types. So it can help the tenant's bottom line.
So lower rent, but they take on those other costs.
Yeah. And they also avoid the risks of actually owning the property. Like if values drop. Plus, it gives them flexibility. They're not tied down managing the building itself.
Okay, that makes a lot of sense. Kind of a win-win in some ways.
It can be, yeah.
But what's the potential catch for Realty Income? What's the risk here?
Well, the main one the Fool points to is a slowdown in consumer spending. If the economy really tightens.
Then retailers might struggle, maybe close stores or try to break leases.
Exactly. That's the worry. Fewer sales could lead to consolidation or, tenants defaulting.
Right. But it sounds like Realty Income has thought about that. Diversification.
Absolutely. That's a key strength. Their portfolio is spread across many industries. No single one is more than 10.2% of their rent.
Okay.
And no single tenant is more than 3.5%. So if one sector or even one big tenant hits a rough patch, it doesn't sink the ship.
That definitely provides a cushion. And their track record, the occupancy rates.
It's pretty impressive. Over the last 25 years or so, their average occupancy has been 98.2%.
Wow.
And get this, even during the Great Recession, it never fell below 96.6%.
That's incredible resilience. Suggests those locations are really essential, right? Pharmacies, convenience stores, people still need those.
Exactly. That stickiness, as you say, is what helps ensure those reliable dividends.
Yeah.
People need their toothpaste and snacks, even in a downturn.
Okay, so that's the physical retail side with Realty Income. Very interesting.
Yeah, steady eddies of the physical world. But what about the digital world? That brings us to number 2, Digital Realty Trust, ticker DLR.
Digital Realty. Okay, so shifting gears completely here. Not storefronts, but data centers.
Precisely. They're also a REIT, but they own and operate the infrastructure, the buildings that house all the servers for cloud computing, AI, you name it.
So they're like the landlords for the internet's plumbing.
That's a good way to put it, yeah. Companies rent space from them. They get the secure facilities, the reliable power, the cooling, all critical stuff, without having to build it themselves.
Which must cost a fortune to build and run.
Oh, absolutely. Huge capital expense.
Yeah.
So Digital Realty provides that as a service.
And are they global or just U.S.-based?
Very global. Over 300 data centers in about 50 metro areas across 25 countries.
Wow. And who rents this space? tech companies mostly.
A real mix, actually. Over 5,000 customers. Yes, big cloud providers, but also financial institutions, healthcare, tech services. Think names like IBM, Oracle, JP Morgan Chase, AT&T, Verizon.
Okay, so a really diverse customer base, too. That sounds pretty stable.
It is. And importantly, the Fool notes that nearly half their tenants have investment-grade credit ratings.
Ah, so less likely to default on their rent.
Exactly. Reduces risk. And again, like Realty income, no single tenant is overly dominant. The biggest is about 11.5% of revenue.
Okay, and the growth outlook here, I mean, data demand just seems to go up and up.
You hit the nail on the head. Demand looks really robust. It's driven by the hyperscalers, the huge cloud companies, and especially now by artificial intelligence.
Right, AI needs massive computing power.
Huge amounts. McKinsey actually projects that AI-ready data center capacity will need to grow, on average, 33% per year through 2030.
33% a year, that's enormous growth.
It's a massive tailwind.
Yeah.
And digital realty is right there, providing the space for it. Think about the processing needed for AI models versus just, storing photos. It's a different scale.
Definitely. So potentially huge demand ahead. What about the dividend and the stock itself right now?
The dividend yield is currently around 3.3%, which is solid.
Yeah.
And interestingly, the stock, it's actually down about 25% from its peak back in December.
Oh, really? So a potential dip.
Yeah, the full piece frames it as a possible buy the dip situation for long-term folks who believe in that data growth story.
Get into a growth industry, get a dividend, maybe at a better price point. Interesting.
Exactly.
Okay, so we've had physical, retail, digital infrastructure. What's the third one?
The third one bridges the gap, in a way. It's Prologis, ticker PLD. They deal with logistics real estate.
Logistics, so warehouses, distribution centers.
You got it. They're one of the biggest REITs in the world doing this. They own and lease out these enormous facilities that are crucial for e-commerce, retail, manufacturing, basically storing goods and getting them moved around.
Right, the backbone of the supply chain, especially with online shopping.
Totally. They're huge globally, too. Properties in 20 countries, serving about 6,500 customers. Over 1.2 billion square feet of space.
$1 billion. That's hard to even picture.
It's vast. And their tenants include the giants, Amazon, FedEx, Walmart, companies that absolutely need efficient logistics.
Okay. Now, thinking back to what we said earlier about tariffs, does that create a risk for Prologis? Their tenants are deep into global trade.
That's a really good point. And yes, the article mentions it. Tariffs could definitely introduce some short-term uncertainty. Businesses might get cautious, maybe slow down inventory buildup.
So a potential headwind there.
Potentially,
Yeah.
in the near term. But it's interesting. You have this tension, right? Tariffs may be causing some hesitation, but the massive wave of e-commerce pushing demand up.
Right, the long-term trend versus short-term policy noise. What does Prologis itself say?
Well, the Fool highlighted comments from their CEO, Hamid Moghadam, on a recent earnings call. He basically argued that long-term rent growth should continue.
Why is that?
Because there just isn't that much new warehouse supply coming online. And it's really expensive to build these things right now.
Right.
High construction costs.
Ah, supply and demand. Limited new supply makes existing properties more valuable.
Exactly. So even with trade wobbles, the underlying demand driven by e-commerce is expected to keep rents firm or rising over time.
And how big a driver is e-commerce for them?
It's huge. The article said e-commerce accounted for something like 56% of the growth in retail goods sales in 2024.
Wow, more than half the growth.
Yeah. And all those online sales need logistics space, warehouses, distribution hubs. That's Prologis' bread and butter.
And they expect that trend to continue.
They do. Their own forecast sees U.S. e-commerce penetration hitting 30% by 2030. It's around 24% now. So still significant room to grow.
So the long-term picture looks pretty strong, powered by how we all shop now.
That seems to be the thesis, yeah.
And what about their stock and dividend? Is it similar to digital realty?
Kind of, yeah. Prologis stock is also down a bit, about 23% off its recent peak from March, and it offers a dividend yield around 4%.
4%, okay. So again, potentially an opportunity for long-term investors who see past any short-term tariff concerns.
That's how the Fool seems to position it, yes. A solid long-term play on e-commerce infrastructure, currently trading off its highs, and paying you a decent dividend while you wait.
Okay, so let's quickly recap the three. We had Realty income.
Right, the retail REIT with monthly dividends focused on those essential type properties.
Ticker O.
Then Digital Realty Trust.
Ticker DLR. The data center REIT, plugged into cloud and AI growth.
And finally, Prologis.
PLD, the logistics REIT, riding the e-commerce wave with warehouses.
And all three picked by the Motley Fool as potential long-term ideas for someone investing around $500.
Exactly. And all REITs, which, as we said, have that structure, often leading to higher dividend yields and giving you real estate exposure without being a landlord yourself.
Right. So, lots to think about there. For anyone listening, maybe consider how these kinds of dividend-paying stocks, focused on different parts of the economy, retail, tech infrastructure, logistics, might fit into your own long-term goals. And perhaps think about those bigger trends, too. AI growth, e-commerce penetration. What do those mean for your investments down the road? Definitely worth some thought.
Absolutely. Encourage everyone to do their own research on these companies and dividend investing in general. Great stuff. Thanks for digging into these with us today.
My pleasure.
And thanks everyone for joining us on the Deep Dive.